Happy Friday, traders. Yes, there is a war going on, but this week was a big week for global central banks. We had most of the big global central banks meeting. And look, what is happening to global central banks is important. Now, look, for the last couple of years, 2024, 2025, global central banks have been in an easing cycle where we have seen global central banks aggressively easing rates. And they have been able to do this, obviously, because they had made some very good inroads into inflation. The expectations for 2026, this year, for global central banks was that they would continue to ease, but at a much slower pace, so much less rate cuts. The heavy lifting by the central banks had already been done in cutting rates. And most central banks were expected to, get to their neutral rate and potentially stay there for an extended period of time. But certainly the market really wasn't pricing in much in the way of rate hikes at all. So this week, the first central bank that we had was the RBA. They did raise rates, and they raised rates for the second time this year. The RBA had an inflation problem before the war started, with inflation ticking up to 4%, and now that inflation problem is going to get even worse. And we've got an RBA that is looking to potentially raise rates again in the May meeting. Looks like that is going to be the next live meeting for the RBA. So one central bank already raising rates. We heard from the Federal Reserve as well this week. Now, the Fed was expected to cut rates at the beginning of this year at least twice the market was expecting, and potentially maybe even a third time. Market now has totally priced out rate cuts by the Fed. Now, the Fed said that the inflation spike from what is happening with crude prices at the moment is still uncertain. So look, the market needs to see some inflation data. We're going to see it in the next month. What's exactly how this crude spike is transferred into inflation, and no doubt potentially, if inflation does exceed expectations, we're going to be looking at potentially rate hikes as well from the Fed at some stage. But what we can say is that it does look with high confidence that the Fed has hit its neutral rate, so the base of its easing cycle, and the next move probably will be up. So that's a big deal. If we have a look at US 2-year yields, which probably tracks the Fed funds rate in the bond market the most, it was trading pre-war under the Fed funds rate of 3.5%, down around about 3.4%. It has jumped up a whopping 40 basis points now to be trading well above Fed funds rate at 3.8%. So that's a bond market already pointing in the direction where they believe the next move for the Fed is, and that is higher. We also heard from the Bank of Japan. They did not raise rates at the meeting yesterday. But certainly, market is expecting Bank of Japan to be raising rates probably in the April meeting, so very close. Bank of Japan rarely raises rates, so when they raise rates, it is meaningful. We also heard from the ECB last night. Now, the European Central Bank's got a big problem in that in Europe, they pretty much import all of their energy and all of their crude. So they are expecting a decent inflation spike in Europe. ECB has a discount rate of 2%. That is way too low. Inflation is going to be trading. It's going to be well above their discount rate, which means it has to go higher. So ECB are looking at raising next month, and then again a couple of months later. So looking for a kickstart of at least 2 rate hikes from the ECB. So look, it looks as if global central banks pretty much have hit their neutral rates. So the end of their easing cycle. And the next move for global central banks certainly is going to be up, and quite a few of them looks like it's going to be happening in the next month or two. So yes, look, that is massively important, this sea change, that we're looking at the end of the central bank easing cycle. because in the last couple of years, central banks aggressively easing has been a huge tailwind for risk. Risk assets love it when central banks are easing rates. So it's no surprise that we have seen equities, global equities doing double-digit growth over the last few years and near record highs. So moving forward this year, we are not going to be getting that tailwind from central banks anymore supporting risk assets. And certainly, it's going to be hard now for those assets to keep these sort of lofty levels. So I would say that the bias now is certainly maybe being on the bear side, selling any significant rallies. Anyway, yes, there is a war going on. It is important, obviously. Market 100% is focused on crude. Crude has behaved itself this week compared to last week. It looks as if the current range is like $90 to $100. And it seems that every time we go over $100, we conveniently get a press conference from Trump, or, and as we saw last night in Israel, from Netanyahu. And it seems as if they want to cap those crude prices above $100, and feeding the market statements that they expect the war to be over soon, and that as far as Israel is concerned, they're not going to be bombing any more of Iran's oil infrastructure. So doing everything possible to appease the market and allay some of their fears and try to get crude lower. So look, so far it has been working for them. But obviously if the war continues on, market's going to start calling their bluff about the war's going to be over soon. And obviously the supply disruptions will continue. And at some stage we may get that spike above $100, which obviously is going to be very bad for risk across the board. Anyway, it is Friday today. We do have gap risk on the weekend, and we have seen in the last couple of weeks that the market certainly has taken crude to the highs of the day on Fridays to the close. Worried about obviously that there could be a gap higher. So. And crude has not had two down days in a row since the war started. We did have a down day yesterday, so if we go by that logic, then today's supposed to be up. Now, finally, precious metals, gold especially, it has had a huge move this week. We opened the week around about 5,000. It traded as low as $4,500 yesterday, so off a whopping $500. We have talked about numerous occasions that it is not a one-way bet anymore with what is going on with the war, and for a couple of very valid reasons. One is obviously what is happening with bond yields. So bond yields spiking, central banks no longer easing, hiking, potentially hiking. That is something gold does not like. It yields nothing. Gold loves it when central banks are easing rates. So that story certainly has not been helping gold. The other story is that when we see a big bout of risk off in the market and the market selling pretty much risk assets across the board, if there is one market they're making money in, gold, then they start to sell that to lock in some profits to pay for losses in the other risk assets. And we also did hear that last night, apparently, a lot of the Gulf states, who obviously their economies have been hemorrhaging with what is happening in the war, that they have been big sellers of gold, trying to raise capital and selling huge, apparently up towards about $7 billion worth of gold last night. So that is that will do it. That will get gold lower. Having said that, it is Friday again, and gold, just like crude, you got serious gap risk if something bad happens on the weekend. So I'd be very surprised if we saw follow through selling gold today, and there's a good chance that gold may see a decent retracement today and close somewhere near the highs, just like probably crude will, because of the gap risk. Anyway, look, yes, very volatile markets. Stay safe out there, trading wise. Have a great weekend. We'll check back with you shortly.